Good afternoon, everyone. The decentralized application I've chosen to analyze is Pudgy Penguins, or PPG, a community owned NFT brand built on the Ethereum blockchain. The core economic problem it aims to solve is one of coordination and ownership in brand ecosystems. Traditionally, brands control intellectual property from the top down, leaving consumers as passive participants. Pudgy Penguins tries to invert that structure using blockchain to allow holders to actually own, license, and commercialize their characters, turning fans into co-creators. To analyze this, I drew on institutional economics and transactional cost analysis. These frameworks help me evaluate how Pudgy Penguins reduces the need for centralized intermediaries and aligns incentives between creators, developers, and holders. My sources include Pudgy Penguin's official materials, but also independent coverage from Coindesk and Decrypt, which verify partnerships like their Walmart toy launch and funding rounds. I also grounded the analysis in course concepts on digital identity, institutional crypto economics, and fintech and DeFi applications. From an economic perspective, the main value driver in Pudgy Penguins is efficiency in brand coordination. By tokenizing identity and ownership, the project reduces transaction and enforcement costs that would normally arise from managing licensing rights through legal contracts. Each NFT acts as proof of both identity and IP, enabling freer use and exchange. Institutionally, Pudgy Penguins demonstrates a shift in trust from centralized brand authorities to protocol-based governance and community consensus. Instead of relying on corporate oversight, reputation and coordination are embedded in the community and in shared digital assets. This represents an institutional reconfiguration consistent with the principles of institutional crypto economics. Of course, there's a trade off. The main benefit is inclusion, as anyone can participate or create content and share in the upside of the brand. But the risk lies in speculation and sustainability. The project's economic health depends on the continuous community engagement and market demand. Without genuine use cases beyond the hype and uh, and novelty, its token value could become unstable, potentially excluding late adopters or smaller participants. To ensure ethical rigor in this analysis, I explicitly avoided relying solely on promotional narratives. I cross-referenced claims from the project's website with independent journalism and on-chain data where possible. I treated forward-looking claims like global adoption or scalable IP licensing with caution, focusing instead on the verifiable outcomes such as partnerships and community governance. This approach ensured analytical transparency and balanced reasoning, in line with ethical research practice. In conclusion, Pudgy Penguins offer a fascinating look at how blockchain can transform branding, changing it from a top-down corporate model to community-owned ecosystems. It's an innovative case of how decentralized identity, governance, and finance intersect into one ecosystem. However, my perspective remains that of cautious optimism, that stakeholders should treat Pudgy Penguins as a social and institutional experiment rather than a worthwhile investment. The best course of action is to monitor the legality surrounding it and the utility of the token before committing resources. Because the success of this decentralized app ultimately depends less on the hype and more on whether decentralized ownership can truly sustain a global brand.